Welcome everybody, and today we will discuss about assessment of firms. Now what is firm? You all know. Firm is partnership, right? Few people come together to do some business, and that is partnership business, and that we call it as firm. Now please try to understand that in real business scenario, or even in commerce or in your business laws, what you study is partner and partnership firm are one and the same. The definition under the Indian Partnership Act 1932 says that all the partners jointly are called as firm. That means partner is not different and firm is not different. This is what under Indian Partnership Act 1932. But when you come to Income Tax Act says partner is different and firm is different. So there is a contradiction here. Contradiction means everybody understands, right? So Income Tax Act says partner is different, firm is different. Whereas Indian Partnership Act says both are one and the same. Jointly all partners are called as firm. So for our income tax purpose, you should remember that partnership firm has an independent entity. Partner is a separate independent entity for income tax purpose. Okay. Now, similar to that, in income tax, when we discussed person definition, we discussed there that partnership firm includes limited liability partnership. So Deloitte Haskinson's LLP is also a partnership, right? So partnership means normal partnership under 1932 Partnership Act or partnership under the Limited Liability Partnership Act. Okay. Now partner may be partner of a partnership firm as per the Indian Partnership Act, or partner may be a partner of LLP also. Okay. Now when partnership firm do business, right? Partnership firm can be for business only. So when partnership firm earns income by doing some business, that income is taxed, correct? The partnership firm's income is taxed. Now please remember that when partnership firm's income is taxed, when that income is distributed to the partners, already tax is paid, right? So when it is distributed, shared amongst the partners, again shall it be taxed or can we tax it? The answer is no. Under section 10 2a, right? Section 10 subsection 2a, it is clear that share of profit received by a partner from the partnership firm is exempt, not taxable. Section 10 talks about exemptions chapter. It is all exempted incomes. Okay. And partner receiving share of profit from the firm is exempt under section 10 subsection 2a. Now there are 5 heads of income which everybody know. Income from salary, house property, business and profession. Then we have capital gains, other sources, correct? Now can a firm earn income from salary? Can a firm go to a job and earn salary income? No, right? So firm cannot earn income from salary. But firm can have own house property which it can rent. So it can earn income from house property chapter. Firm can do business, it can earn income from business and profession chapter. Firm can have capital assets, building, plant and machinery. It can sell and earn capital gain income. Firm can have deposits on which it can earn interest. So it can even earn income from other sources. Okay. So this way you should remember. So firm can earn income from house property chapter, business and profession chapter. income from capital gains and income from other sources. Please remember that I said partner is different, firm is different. For that, registration is not a compulsion, right? Registration is not at all compulsory. Are you clear with? If the firm is registered, then only it is different. Otherwise, they are same. Nothing like that. If the firm is registered or not registered, in both the cases, firm is different, partner is different. Okay, very good. Now we understood all this. Firm gets all the deductions which a normal business will get under section 30 to 37. Additionally, firm has deductions under section 40B. What are the deductions? Interest on capital or even loan given by partners. If suppose partner has given any loan, partner has invested capital, on that whatever interest is there, that is allowed as deduction. And second one, remuneration to partners, that is also allowed as deduction to the partnership firm. Okay. Now please remember, there is a section called as section 185. It says that if you want to claim these two deductions, that is interest and remuneration under section 40B, you should satisfy conditions under section 184. Now section 184 lays down 4 conditions which you should remember. First condition, that partnership should be evidenced by a instrument. That means there should be a partnership deed. That's it. Second one, when the partnership firm is registered, first time when it files the income tax return, first time when the partnership files the income tax returns, at that time, along with the income tax return, they should also submit the partnership registration certificate. Okay, 2 conditions I said under section 184. One, partnership should be registered. That means partnership should be evidenced by an instrument. Second one, first time when it files the income tax returns, it should also submit partnership deed. Third condition is that the share of profits of the partners share of profits should be determinate, certain. Okay, like 3:2:1, some ratio, clear ratio should be there. Fourth thing is, there should be no default under section 144, right? So 144, if you are not filing the returns, not showing the income details, all such blunders you should not do. So 184 lays down 4 conditions. One, there should be a partnership deed in writing. Second one, file that partnership deed along with income tax return for the first year. Third, share of profits of partners should be fixed. And fourth, no default under section 144. If these 4 conditions are satisfied under section 184, then 185 says that you can claim deduction under 40B, that is for interest and remuneration. But if you fail to comply any one of these 4 conditions, then 185 says that interest and remuneration are not allowed as deduction. Interest to partners or remuneration to partners not allowed as deduction if you fail conditions under section 184. Okay, very good. Now come to the next story. This is very clear, but please remember that there is something called as interest on capital. When it is allowed? If there is a partnership deed then only it will be allowed, right? If there is no deed, can we allow interest on capital? No, right? Now, second point, interest on capital should be paid before the date of the deed or after the date of the deed? Simple, right? After the date of the deed. So these are the two conditions for claiming the deductions. First, there should be a proper partnership deed. That means the partnership should be evidenced by instrument, right? Second condition is that the interest should be paid only after the date of the deed. Okay, so suppose if interest is paid before the date of deed, it will not be allowed as deduction. Okay, sir, if there is no deed, then interest will not be allowed as deduction. So deed should also be there and interest should be paid only after the date of the deed. These two are compulsory conditions. Okay, how much deduction you will get? One, actual interest. First thing is what? Actual interest which you are paying as per the deed. Interest as per the deed. Actual interest as per the deed. Second one is 12%. Right? So whichever is lower will be allowed as deduction. What? Actual interest as per deed or 12%, whichever is lower will be allowed as deduction. Okay? Clear? Right. Now, think about, if suppose there is somebody called as representative partner. Now why this representative partner comes into picture? I'll tell you. Suppose example, Tata's and Reliance want to get into a partnership. Now Tata and Reliance cannot be the two partners there, right? Because they are companies, they are artificial persons. So to represent Tata Sons, to represent Reliance Industries, there should be some individuals. So that individuals are called as representative partners. Reliance will appoint one individual, Tata will appoint one individual. These two become representative partners. Correct? Sometimes what happens? A minor is there. Now you cannot make him a partner. So what will happen? On behalf of minor, the guardian will become partner. So this is the concept of representative partner. On behalf of, right? Reliance, for the benefit of minor. So the representative partner. So representative partner is a partner who acts as a partner on behalf of or for the benefit of another person. Clear? Now, can we actually pay interest to representative partner or to the beneficiary? The answer is yes. Will it be allowed as deduction? The answer is yes. Sir, section 40B restrictions? Yes, it will also apply. So everything will be same, no change. Okay. If it is actual partner or representative partner, doesn't make a difference. But suppose if representative partner is receiving the interest not as a partner, maybe somebody has given the loan and the representative partner is receiving interest for the loan given to the partnership firm, which he has to pay back to the lender. In this case, it will not be covered under 40B, but it would be covered under section 36, interest on borrowed capital. And obviously it would also be allowed as deduction. No doubt about it. Okay. So representative partner, what they said, clear? Yes or no? Very good. So we discussed it till now all about interest. I don't feel that you should have a doubt. Chalo, let me recap for you. We started discussing about assessment of firm. Right? We said that for income tax purpose, partner is different, firm is different. Partnership firm includes LLP. Now firm will pay tax on the income what they earn, right? 30% is the rate of tax for partnership. If income of the partnership is more than 1 crore, then 12% surcharge will also be applicable. And health and education cess is obviously there. So this will anyhow apply. So when firm pays tax on the profits, again when that profit is distributed to partner, should they again pay the tax? The answer is no. As per section 10 subsection 2a, it is fully exempt in the hands of the partners because firm paid the tax. And third point, firm will pay tax either under the head house property, pgbp, capital gain, other sources, not under salary because it is not an employee. For this purpose, firm need not be registered. We discussed that deductions under section 40b can be claimed, but for that 185 says satisfy conditions under 184. The conditions are there should be proper partnership deed. While filing the first income tax return, you should submit the partnership deed to income tax department. Share of partner should be fixed and no default under section 144. Interest to partners, whether it is interest on capital or loan, will be allowed as deduction, no problem. But for interest on capital, two conditions are there. It should be authorized by the deed, partnership deed, and finally the interest should be paid after the date of authorization in the deed. Okay, right. And what should be the deduction? Whatever actual interest as per deed or 12%, whichever is lower. And even representative partner can also claim deduction. Reliance example, minor example, right? You remember. Finally, I said that if representative partner is receiving interest not as a partner, then it can be claimed as deduction under section 36. That's it. Interest on borrowed capital. Now come to remuneration of partners. Remuneration means salary, commission, bonus and fees. Remuneration means salary, commission, bonus and fees. Salary, commission, bonus and fees. These four come under remuneration. Salary, commission, bonus and fees. Salary, commission, bonus, fees is remuneration. Will it be allowed as deduction? Yes. What are the conditions? First thing, we will pay remuneration to working partners or sleeping partner. Suppose somebody is working under you, you will pay salary, correct? If he is not working, will you pay salary? No, right? So, salary is paid to that partner who is a working partner. First thing to remember. Second thing, third thing are same. The remuneration should be authorized by the deed and the remuneration should be paid after the date of the deed. So to claim remuneration as deduction, three conditions. One, the partner should be working partner. The remuneration should be authorized by the deed. And third thing is that remuneration should be paid after the date of the deed. Okay. Working partner who is actively participating in the operations of the business. Now, don't feel that he should be full time available to consider as working partner. To call him as working partner, he should be involved in day-to-day affairs. Time has nothing to do with it. Right? Okay. Now, how much deduction? Actual remuneration paid will be allowed as deduction or the maximum amount as per 40B. Right? Maximum amount as per 40B or actual remuneration, whichever is lower, will be allowed as deduction. Okay. So what is the maximum remuneration? Just you can see the table, right? In that table we discussed about maximum remuneration. But to understand maximum remuneration, you should know something called as book profit, right? So let me teach you book profit first, right? Once you understand book profit, then you will be able to understand how this maximum remuneration is computed. See the book profit now. First step, अरे यार accounting net profit you should compute. Easy or difficult? First step over. Second step, we will do all PGBP related adjustments, right? Under section 28 to 44, that all adjustments, including 40B interest adjustment also. Do all the adjustments. If something has to be added, add it. Something has to be deducted, deduct it. But get the income as per Income Tax Act. Get business income as per Income Tax Act. Then you need to also add remuneration. Now please remember, if remuneration is given in the P&L account, then only add. Okay. Step 3 they said add remuneration. Not over. If it is given in P&L account, then only add. Okay. And finally, fourth thing I'll tell you, very important, that you can deduct unabsorbed depreciation. There are two words. One is unabsorbed depreciation and second one is brought forward loss. Right? Unabsorbed depreciation one thing and second one is brought forward loss. Unabsorbed depreciation, you can claim it as deduction. Brought forward loss, you cannot claim it as deduction. Right? Now, you may be confused with the meanings of the words. PGP chapter we did, so you understood what is unabsorbed depreciation, right? Unabsorbed depreciation is simply last year's profits were insufficient to claim the depreciation. Suppose profit is 8 lakhs and depreciation is 10 lakhs. So in that case, can you claim 10 lakhs as deduction, depreciation? No. So 8 lakhs you claimed depreciation, profit became 0. Now that extra 2 lakhs depreciation is there, na? That is unabsorbed depreciation. Right? 8 lakhs profits, 10 lakhs depreciation. That 2 lakhs extra depreciation is unabsorbed. That you can deduct in the next year for unlimited number of years. Here also you can claim it as deduction if you did not claim in the past years. Okay. Same way brought forward loss. Last year you got business loss. You were not able to adjust the business loss from any other income. So you can carry forward that. That means you can adjust the loss of last years in the current year, next year, like that. So when we compute the book profit, step 4 says you deduct unabsorbed depreciation. But brought forward business loss you cannot deduct. Right? Chalo, again I am repeating first 4 steps for computing book profit. First step is you have to calculate profit as per accounting. You have to calculate profit as per accounting. Second step is section 28 to 44 PGBP related sections. You will apply and compute the adjustments. Right? Do adjustments as required. Third thing you should remember that interest adjustments also you should do. Fourth thing you should remember, that is step 3, that remuneration if it is shown in P&L account, add. And fourth thing, deduct unabsorbed depreciation but cannot deduct brought forward loss. Now please remember, after deducting unabsorbed depreciation, you will be left with some profit, correct? That profit, whatever is left, should not be less than the brought forward loss. The profit what you get should not be less than brought forward loss. Okay. So can you claim unabsorbed depreciation whatever it is? The answer is partially yes, partially no. So you try to just deduct unabsorbed depreciation. You get the book profit as per step 4. But see, if book profit is more than or equal to unabsorbed, more than or equal to book profit. If it is the case, no problem. But if suppose book profit is less than brought forward loss, then you try to adjust your unabsorbed depreciation to such amount which will ensure that your book profit is equal to brought forward loss. Okay. Suppose I will tell you your book profit before unabsorbed depreciation is 10 lakhs. Unabsorbed depreciation is suppose 1 lakh. So how much will be your book profit? 9 lakhs. Suppose your brought forward loss is 8 lakhs. Book profit is 9 lakhs, brought forward loss is 8 lakhs. No problem at all. Because book profit is more than brought forward loss. Okay. But suppose brought forward loss is 8 lakhs. Your book profit before unabsorbed depreciation is 10 lakhs. But unabsorbed depreciation is 5 lakhs. Now can you claim 5 lakhs as deduction? The answer is no. Because it will take the book profit to 5 lakhs rupees, less than brought forward loss. So what you should do? From 10 lakhs, you should deduct only 2 lakhs unabsorbed depreciation, so that your book profit will come to 8 lakhs, which is equal to brought forward loss. Okay, this you should be able to do. Right, now come to the next. Can you pay remuneration to the representative partner? Perfectly alright, you can pay remuneration to representative partner also. Now, to whom it is taxable? To the representative partner or to the organization? Like if suppose Mukesh Ambani ji is representing Reliance, so the profit salary which Mukesh Ambani is receiving from the partnership firm will be taxable to Reliance or to Mukesh Ambani, because Mukesh Ambani is just representing Reliance. The government said no, it is taxable only to Mukesh Ambani. To the representative partner, right, the salary received will be taxable to representative partner, not to the organization. Okay, clear, right? Hey, who receives salary yaar? Will Reliance receive salary? No, right? Individual receives it. That's why they say it like this. Okay. Shall I go to the next part? Now you understood all these things. Please remember, in computing the book profit, your other sources chapter, capital gains chapter, house property, all this has nothing to do in computing book profit. So all this should not be considered, not have any impact also. Okay, suppose you see in the P&L account, income from house property, income from other sources, income from capital gains on the credit side, right? It is common. Then you have to deduct the 3. Simple, right? Next thing, deductions under chapter 6a, that also you need not deduct for computing book profit. Now this way you got the book profit. Now take this book profit. Is it in losses? See the table now, maximum remuneration table. Okay, is it losses? If losses are there, then you can claim a remuneration, the maximum remuneration, up to 1,50,000 rupees. How much maximum remuneration you can claim? Up to 1,50,000 rupees. But suppose you are into profits, then the government said, okay, we'll divide profits into 2 parts. Up to first 3 lakhs profit and then balance profit. That means more than 3 lakhs profit. Okay, up to 3 lakhs profit, what they said, 90% of the profit or rupees 1,50,000, whichever is higher will be considered as maximum remuneration. Suppose example, your actual profit is 2 lakhs rupees. Then 2 lakhs is book profit. Okay, then 2 lakhs into 90%. So how much? 1,80,000 or 1,50,000, which is standard amount, whichever is higher. 1,80,000 will be allowed. Suppose your actual book profit is 1 lakh rupees, then so 1 lakh into 90%, 90,000 or 1,50,000, whichever is higher, that means 1,50,000 will be allowed. Okay. Now suppose example your book profit is 5 lakhs rupees, then what to do? Then first 3 lakhs, right, and next 2 lakhs. So first 3 lakhs 90%. So 3 lakhs into 90%, 2 lakh 70 or 1 lakh 50, whichever is higher. 2 lakh 70 will be allowed, right? 3 lakhs into 90%, 2 lakh 70. Standard amount 1 lakh 50, whichever is higher should be taken, right? So 2 lakh 70 will be maximum remuneration. On the balance 2 lakhs, right? 60% they said. That means 2 lakhs into 60%, 1 lakh 20,000. So that 2 lakh 70 plus 1 lakh 20, 3 lakh 90 will be maximum remuneration. Okay, as per the law, as per section 40B. Now this amount you compare with actual remuneration, and whichever is lower will be allowed as deduction. Whichever is lower will be allowed as deduction. Actual remuneration which is given in the question, and maximum remuneration which we computed just now. So will you directly compute maximum remuneration or first compute book profit? So first you should compute book profit, then only you can compute maximum remuneration. Then only you can compare with actual remuneration and decide what is allowed as deduction. Okay. So the page seems like this 1, 2, 3, but it is 3, 2, 1. Book profit, maximum remuneration, and then above. Great. So remuneration related part also I feel you understood in totality, right? How much remuneration should be allowed, representative partners related concepts we discussed, right? Wait a minute. Yeah. Next question comes that okay, if there is no registration, okay, no problem. What's there in it? Registration doesn't. Okay. Registration affects section 40B, right? If registration is not done, then you cannot claim this remuneration or interest as deductions, right? But if you don't do registration, your share of profit which you are distributing to the partners, that will continue to be exempt even if you did not register as a firm. Okay, very good, clear. Now come to the next point, constitution. Partnership constitution means only two things to remember: admission, death. What will happen in case of admission and death? Nothing. You just change the partnership deed and submit it to the income tax department, right? As per the new deed you will get the deduction. Suppose if you don't submit the change, then you can claim deduction under the old provisions, old deed, as per the old deed. That's it, nothing more than that. Arey yaar, I forgot something which I have to share with you, right? I just spoke about the partnership, but did I speak about the partner? Right? Partner share of profit, interest and remuneration to partner, did I discuss? No. Right? Don't worry. We'll just complete the constitutional effect and set off and carry forward under section 78, and then we'll come to this. Right? Okay. Now what I said, constitutional change means what? Change in the profit share. Right? If there is a change in the profit share, or if there is any admission or death, in that case what will happen? You should submit the new partnership deed to the income tax department, right? When you file the next income tax return, then you can claim deduction under 40B as per new provisions. Otherwise as per old provisions, nothing, no complication at all. Okay. And finally, can we set off and carry forward? The section 78 clearly says, suppose A, B, C are the partners. They are into continuous losses. Suppose now 30 lakhs is the loss. C and all of them are equal share they have in the profits. Right? A is B, C. 1 is to 1 is to 1. And their loss is how much? 30 lakhs. Which they want to carry forward on a continuous basis. Right? Now what happened? C died, or suppose C retired. C died means deceased word is used in the books, right? In this case, what will happen? Can the firm continue to claim 30 lakhs as deduction? The answer, the set off and carry forward, can they claim 30 lakhs? The answer is not at all. The person who retired or deceased, his share will be blocked for claiming the set off and carry forward. That means if it is equal share 1:1:1, then 30 lakhs into 1 by 3, that is 10 lakhs. They cannot claim it as deduction. So A and B both are alive, right? They are continuing in the firm, right? So that 20 lakhs they can carry forward. Now you may be asking me, sir, why like this? The answer is very simple. Arey yaar, when some partner dies or he retires, his accounts will be adjusted, correct? His loss will be deducted from the capital and then only he will be paid the balance amount, correct? So that is anyhow adjusted. That's what the presumption is, and that's why if some partner retired or deceased, his share of loss will not be carried forward. That's what section 78 says. Just little back, we'll go to the last page. Now, we computed the book profit of the firm, right? Now, after computing book profit, we calculated even maximum remuneration. What next? The simple answer is, take the book profit, from that book profit deduct the remuneration, right? Deduct the remuneration and you will get the business income. Okay, from book profit deduct the remuneration, right, which we computed just now. Write remuneration as per income tax, that maximum remuneration or actual remuneration, whichever is lower, that you computed, right, that you can deduct it here to get business income. Now this business income is distributed amongst the partners, share of profit by partners. I already said that this share of profit is exempt under section 10(2)(a), right? Now share of profit is already exempt under section 10(2)(a). Okay. Oh, 10(20)(a). No, 10(2)(a) is right, correct. As per section 10(2)(a), it is exempt for the partners. Now, actual remuneration may be 10 lakhs, but as per law, 8 lakhs is allowed. Okay. Now, 2 lakhs is not allowed, right? 2 lakhs is not allowed. So, when 2 lakhs is not allowed, the firm is indirectly paying tax on that 2 lakhs. Correct? And when 8 lakhs is allowed to the partnership as expenditure, then if it is expenditure as for the firm, if it is expenditure for the firm, it becomes income for the partners. I am only talking about salary, remuneration. If it is expenditure for the firm which is allowed, it is taxable as income to the partners. Same way, whatever interest is deductible in the partnership, right, up to 12% or actual interest as per deed, whichever is lower, whatever is deducted while computing, right, business income, that will become the income to the respective partner, right? So interest and remuneration rule is simple. What is allowed for computing business income of firm, that becomes taxable income for the partner. And share of profit also, rule is clear. Anyhow firm is paying tax, so it is exempt in the hands of the partners. So I covered all the concepts 360 about the assessment of partnership. No doubt should be remaining in your mind. Okay, great.